Welcome back. Today, we're diving deep into one of the most debated ETFs out there, SCHD. Now, if you've been hanging around investment forums or YouTube comment sections, you've probably seen the same argument pop up over and over again. SCHD is a terrible investment for retirees. Don't touch it. But here's the thing, that statement is, frankly, misleading. In this video, I'm going to break down the myths and realities of SCHD, why people get it wrong, and why it might still be a strong addition to your portfolio, even if it hasn't been the absolute top performer over the last few years. We'll talk about its total returns, how it compares to other ETFs like VOO, the criticism around compares being removed from SCHD, and even how SCHD's long-term performance stacks up against some alternatives. So if you're ready, grab a notebook, get comfortable, and let's unpack this fully. By the end of this video, you'll see SCHD in a whole new light. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the most common argument I hear. SCHD has been a bad investment for retirees because the total return has been terrible recently. Now, let's pause for a second and really break that down. People throw around the word terrible like it's self-explanatory, but in investing, the term has to be put into context. For example, over the last few years, SCHD hasn't lost 20% or 30%. In fact, it hasn't even lost more than 5% in a single year. On the contrary, it's actually gained about 5 to 6% per year on average recently. Now, 5 or 6% might feel small if you've been watching ETFs like VOO, which have sometimes gained more in the short term. But here's the catch. Just because another investment made more money in a short window doesn't mean SCHD is a bad investment. Let me explain this in simpler terms. Imagine someone says, I invested in SCHD and it only gained 6% this year, but VOO gained 12%, so SCHD was terrible. That sounds convincing, right? But the logic is flawed. You can apply the same reasoning to literally every investment. If you invested in Regan Cell Biosciences, which skyrocketed 11,130% this year, yes, that's real, you could have made way more money than anyone invested in SCHD or VOO. Does that make every other ETF bad? Of course not. Even if we look at S&P 500 stocks, Western Digital gained 276% in a certain year. If we judged every investment by whether it beat Western Digital, literally no one would ever say any ETF or stock was a good investment. The point here is this. SCHD meets its objectives. It provides consistent growth, diversifies your portfolio, and limits risk. It's not about being the absolute top performer every single year. And that's exactly why judging it based on VOO's recent outperformance is unfair. Next, let's talk about the second big complaint. SCHD always removes the best companies from the ETF, so you're missing out on gains. Yes, this has happened. And yes, people get frustrated when companies like Broadcom get removed. Broadcom's price had gone up, its dividend yield dropped below SCHD's threshold, and during the ETF's annual rebalancing, it got kicked out. People see that and panic, thinking, I just lost potential gains. Here's the reality. SCHD is a dividend-focused ETF. Its goal is to hold companies that provide strong, sustainable dividends, not necessarily the absolute highest growth stocks at any moment. So when a company like Broadcom gets removed, it's not a personal attack on your portfolio. It's just a rule of how the ETF is structured. And here's the kicker. You can take matters into your own hands. If SCHD removes a company that you really like, you can simply buy shares of that company individually and hold them alongside your SCHD shares. This way, you effectively create a SCHD plus portfolio, capturing the dividends from SCHD while not missing out on individual growth opportunities. So, complaining that SCHD removes companies isn't really fair. It's like blaming your car for having turn signals. The tool is working exactly as designed, and you have the power to complement it. Now let's compare SCHD with another popular dividend ETF like JQ, Jupiter Income ETF, or similar. People often say, why not just go with JQ? It has a higher yield right now. Sure, JQ might be offering 9.5 to 10% yield in a given month, while SCHD is around 3.87% at the moment. But here's the important nuance. SCHD's yield grows over time, while JQ's yield is more static. If you invest in SCHD today and hold it for 15-20 years, your yield on cost, the amount of dividend income you earn relative to your initial investment, will grow significantly. For instance, if you had invested $1 in SCHD 15 years ago, your yield on cost today would be 12.74%. That's compounding growth you can't ignore. In contrast, a static high-yield ETF may offer a high payout now, but it doesn't have the same growth trajectory. This is a key difference that gets overlooked when people compare SCHD and JQ. They look at today's numbers rather than the long-term potential. Investing is not about chasing the highest yield this month. It's about building a portfolio that grows and supports your financial goals over decades. Another important point is diversification. SCHD isn't trying to be a superstar in one sector or stock. It spreads your risk across many high-quality companies. Even if some companies get removed, the ETF maintains balance and reduces volatility. Think of it this way: SCHD is like a well-balanced meal. Sure, you might miss out on the sugar rush from candy, short-term gains from a hot stock, but your long-term health benefits, steady growth and dividends, are far more important. And the numbers back this up. Over the last 15-20 years, SCHD has consistently provided positive returns and steadily increasing dividends. It has protected investors from the massive swings you sometimes see with high-risk, high-reward stocks. That's exactly what retirees and long-term investors need: a reliable, stable growth engine that won't keep you up at night. Let's address another misconception. People often think SCHD's past performance doesn't matter if it's underperforming in a given year. Here's the thing: investment success is measured over decades, not months. A single year where SCHD doesn't beat the hottest ETF or stock doesn't define its value. SCHD is designed for the long game, not for day traders looking for next week gains. Over 10, 15, or 20 years, SCHD consistently pays dividends, grows your yield on cost, and reduces the risk of major portfolio losses. If you evaluate it like a short-term investment, you're missing the point entirely. Now, let's summarize why SCHD is still a strong investment, despite what some critics say. Steady returns. SCHD hasn't had catastrophic losses. It might not beat every ETF every year, but it consistently grows at a reasonable rate. Long-term dividend growth. The yield on cost has increased over time, meaning your future income grows if you stay invested. Portfolio diversification. It spreads risk across multiple high-quality dividend-paying companies. Flexibility with removed companies. If a company gets removed, you can buy it yourself and enhance your portfolio. Long-term strategy focus. SCHD is built for long-term wealth accumulation, not short-term speculation. So, here's the takeaway. SCHD is not a bad investment for retirees or long-term investors. Sure, it may not always be the fastest-growing ETF or the highest yield option in the market, but it does exactly what it's supposed to do: provide consistent growth, dividends, and diversification over decades. Critics often focus on short-term performance or removed companies, but if you take a long-term perspective, SCHD shines. Comparing it to the latest hot stock or high-yield ETF is missing the point entirely. For investors who are patient and strategic, SCHD can be a cornerstone of a strong, resilient portfolio. So, next time someone tells you SCHD is terrible, remember, it's all about perspective, long-term growth, and steady dividends. That's it for today's deep dive into SCHD. If you found this helpful, make sure to hit the like button, subscribe for more investing insights, and comment below with your thoughts on SCHD or other dividend ETFs you like. I'd love to hear your strategies. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and